Hello, friends. Welcome to this edition of Corporate Interaction Investonomics, which we always bring to you. This time, today, we are bringing you Brigade Group. Mr. Atul Goyal, the Chief Financial Officer of the group, is joining us today to give us insights about how the company is doing. Over the last few quarters, especially the last 2 quarters, we actually have seen a dream run for the company, for the stock, for the financial performance. What a stellar sort of sales growth we have seen across the vertical, the residential, commercial, residential in particular, has seen almost one of the best times in the last few years. Mr. Goyal, welcome to the show. And my first question would be straight in terms of FY23 expectations. We have seen it has been a dream run for the company. How you're seeing post-March, post-Jan to March quarter, how you're seeing the first 6 months for the company from a grounds up insight perspective? Is the residential sales momentum still continuing? Are you still looking at strength in the disposable purchase income?
Yes, thanks, Piyush. I think resi sales are still continuing. I think momentum is there in the market. I think it may be because of the consolidation, good developers, which are now very less in India as a country as a whole. So I think consolidation has played a major role. And today the growth level or the momentum is still there because affordability has increased. See, we are in a market which is a southern market, and our market comprised of Chennai, Bangalore, and Hyderabad, which is an IT/ITES hub. And everybody knows that affordability in IT/ITES has increased tremendously the way things have been going. So I think affordability is there, and that's why sustenance of momentum is there. People are upgrading their households from 2-bedroom to 3-bedroom, 3-bedroom to 4-bedroom, because many companies, though they are confused as to how they have to operate, but hybrid model is still being preferred, and people are going to office at least 2 to 3 days in a week, and 2 to 3 days they are working from home. So requirement of larger homes have definitely grown high, and I think that is pushing up the demand. Yes, there are some downers like increase in interest rates, or which may, or the inflation in the construction cost of the projects, which may lead to higher prices. But I think people are more or less fine with that. We have done our calculation. The 90 bips increase in interest rates is leading to around 5% of increase in EMI, and that can be also actual increase in EMI or increase in the period. So I think customers are fine. They are still looking at it, but future, it's very difficult to say. The way interest rates are increasing, how this happens, nobody knows. But I think banks, the retail market for the home loans is very, very hardly contested between the banks, and banks are not able to pass overall increases of 90 bips to each and every customer. So I think it's a hard-fought market. I think customers will gain from that. But we are very clear that momentum is going to stay there, and we are expecting and looking at in Q1 also.
Right. You actually have touched upon a few of the questions I wanted to ask you. So I will go deeper into that slightly later. But the first question I wanted to ask you, and the most interesting part, I think the investors on our ICICIdirect platform and across the stock universe, they first actually would be thinking that, yes, we have seen a lot of salary hikes, a lot of startup booms. We have also seen a tremendous hiring boom over the last few months. Now, from your own perspective, we have affordable category, we have the mid-size income category, and we also have the luxury category. So right now, where is the highest boom, and where you are focusing at present?
So highest boom is in mid-size income category. If you see a recent report from around 68 to 69% of our all inventory all over India is in mid-size houses. And the reason being that is more affordable. We are into that. Maximum of our sales are in mid-income housing, which ranges from say 60 lakhs to 1.5 to 1.7 crores. So I think that is a very sweet spot today. Affordable has become very unattractive for developers to grow because there is a limit of 45 lakhs for a city like Bangalore, and with no increase given by the government in the prices, it's very difficult to sustain the construction cost, where the inflation is around in the tune of around 12 to 13% escalation in the construction cost. So affordable is becoming unaffordable for developers. But mid-income housing, I totally agree, is a sweet spot, and maximum of our sales are in that area.
Right. Mr. Atul, if I want to ask you over the next like the course of FY23, what is the size of launches we should be expecting in the mid-size category for you?
So see, 8.3 million is what we have targeted, and that is what we have shown in our investor presentation. So mid-income housing will be around 80 to 85% in that.
Right. And over the quarters, is there any sort of quarter where we should be expecting like a bulky quarter or major part of the launches, or it's going to be spread out evenly?
See, it's very difficult to spread out evenly. It depends upon the approvals which are coming, but we are trying to spread out evenly. But I think maximum launches should happen in Q2 and Q3. That is what we are expecting, the way approvals are going for. So I think maximum will be in Q2 and Q3.
Right. And from a city perspective, because you highlighted Hyderabad, Bangalore, and Chennai, and as the IT hubs, you just pointed out. I've been reading some of the data, and both in June also, in this quarter also, we have seen massive salary hikes. We have seen salary hikes across the sort of experience brackets. So any particular city where you're seeing a very strong dynamics, or it is spread out evenly across the three major cities you're targeting?
So it is, I would say, dynamics are spread down equally in all the three cities, but Hyderabad has been very, very good. I think the price increase which we could take in Hyderabad was very, very sustainable, and I think Hyderabad market is doing very well. Though sourcing land has been an issue in Hyderabad because of unlimited FSI, and I think government is now going to cap FSI limits there, so then it will become more affordable. But Hyderabad market has been definitely doing very, very good. Chennai has surprised us. Chennai, we never thought we'll get so much price increase there, and the luxury sales for our WTC residences has been doing very, very well. And of course, we have already sold 60 to 65% of our stock in WTC residences, where where the ticket size is more than 2 crores, 2 and 2.25 crores. And even Xanadu there, which is at Moga Pair, has been doing very well. So Chennai has surprised us. And I think Chennai now, with the land acquisition which is going on, we may be one of the largest developer who are operating in Chennai. So that gives definitely an advantage there. Bangalore, is a hard-fought market, but we have been doing very, very well. Our Utopia in Varthur has been doing very, very well, and we are going for a second phase, third phase of land in that area. So East market, we have been covering that. North Bangalore has been doing very well, and we have a presence there. We are also first time going into the plots this time, and we'll be launching plots soon in our orchards and in North Bangalore, where we are tying up the land. So there are a lot of opportunities today, and we are looking at it at each and every juncture.
Well, you continue to sound happy, and I think the investors will be actually feeling delighted to hear you. But moving on, let's ask one more question here from the perspective of price increase. You stressed on the price increase, and this is what I wanted to ask you, because there is always a period in the real estate where you see continuous price momentum. The underlying dynamics is that actually disposable income rises, and people actually want to buy flats or land as soon as they can. Now, after having a very strong 6-month period, what is your own expectation on a price increase? Is this price increase trend, can it actually continue to move on like this, or you are expecting now a flattish price environment and a strong volume growth?
See, flattish price has been there for last 3-4 years. And I think that demand is increasing now. And see, whatever price increase has been taken by developers as on today is mainly because of the escalations in their construction cost, which has happened. So this price increase should be, developers should be able to do it the way market is growing. I think that in future, we should be able to take at least 5 to 10% price increase going forward and year on year. That is what we have assumed in our budgets and target. But let's see, it's a market stability. If interest rates or escalations or inflation is very, very high, it will definitely pose a problem for developers to have a rate hike.
Right. And despite the sort of continuous interest rate hike we are seeing, are you confident that this could continue, the price increase in the FY23? Because the Reserve Bank of the RBI governor, he continues to highlight that we can see some more interest rate hikes.
Yeah, I know. Customers also expect that, and customers are prepared for a rate hike. See, 2 years before, you were paying home loan rates at 9.5%. You are still at 7.4. So there's a lot to be covered, and you still, after rate hikes, you cannot get such a home loan rate which has come in years to the customers. So property still remains attractive. Equity markets have been not doing that well because of the rundown, and this is a time when people turn to real estate for a stable income in their portfolio. So that plus many NRI investments are being happening with the rupee going down against the dollar. So that is also a very, very big inflows which are coming. So I think this momentum will maintain. There may be some dampener, as I am saying, for the interest rate hike, but things should smoothen out and demand should sustain.
Right. And volume growth, I know you've already alluded, 8 million square feet of the residential launch you are planning for FY23. Now, numbers sometimes could be unfair because your past year was very, very solid, and that's why the YOY could be slightly tough. But in terms of absolute numbers, it still looks very solid. But on a YOY volume growth, what is your own expectation? How is FY23 looking to you?
It's very difficult to say now. We are in the first quarter itself. But internally, we have targeted around 20%, 15 to 20% increase in our pre-sales numbers this year. Let's see, market is volatile, as I said earlier, because of the interest rates and the inflation. But we are hopeful that definitely we'll cross last year's number and we'll try to up it by 10 to 15%. That is what we are targeting. We have very good launches which are coming now in this year, and we are very hopeful.
Right. Sounds good. Now, let's move away for a bit here on the hotels, co-working space, the segment again, which you have been trying to develop. Seems again, they've been picking up well. Please help us understand what sort of contribution they're making right now, where they're looking to move in FY23, and what's the underlying trend there?
See, hotel has gone to a worst phase in this COVID period. Last 2 years have been very tough for hotels, and who have survived this COVID time, they are going to do a tremendous business in hotels going forward. There are many people who have gone bust. They are not able to perform because of the various commitments of loan debt which were there for the hotels. But big players like us have sustained this 2 years of COVID period. And of course, government was helping us with the ECLGS, which they had provided, and banks were giving to the good customers, and we have also got it. So hotels, now the things are returning to normal. International travel has started. Inland travel, corporate travel has started. I cannot disclose much numbers. I will only say that May, June has been very, very good. In May and June, we have surpassed the pre-COVID levels, both in occupancy and ARRs during these 2 months. And we are hopeful that hotels should do very, very well, and we should show a tremendous revenue increase in this year, by this year, and in our financials.
Mr. Goyal, I'm interested to know, when you're saying hotels are doing well, what sort of EBITDA margins you would be seeing them like work around?
It should be around 20 to 22% is what we are targeting. But let's see. See, lot of saving has been done by the hotels also, by reducing the staff, by room to staff ratio. So there's lot of churning which has happened in hotels, and they have become more cost effective. So I think EBITDA should increase consistently, but we are hopeful that 20 to 23% or 22% we'll be able to achieve.
Right, and compared to that, the blended group margins, where do you see moving from here?
So blended margins, I think, is more or less same. We have been consistently saying that we should be in the range of 25 to 30%, and that blended margin will continue. Real estate has been doing well. Our margins, our leasing is improving in commercial, and as and when leasing improves, overall margins also improves, because right now our leasing is not covering depreciation. But going forward, the way full leasing happens, it will cover that also. So EBITDA margins, I'm talking on overall, but EBITDA margin definitely it should be in the range of 25 to 30%, which we have been maintaining since we have come to the market.
Okay, and in terms of capital allocation policy, where are you looking to put capex for FY23, at least for the next 6 months, if you say? Number one, and number two would be within the business. Any particular plans of any material increase in the capex?
So see, we have raised QIP of 500 crores, and we have been sitting on 1500 crores, as you can see from our investor presentation. So we are sitting on a lot of cash. There is a lot of focus on the land buying. If we are looking for a residential sale increase of around 15 to 20%, we need to build our land bank, and this is the right time. Our focus is mainly on the residential land bank, and we have been buying lands both in Chennai, Hyderabad, and Bangalore, and will continue to do that. As far as commercial, right now, one project of Twin Towers which is going on, and we are looking at various options in commercial as well. But we are a bit cautious as to, we are very clear that we should be able to lease 1.2 million, which is there in our commercial segment, and then we should move ahead with doing a pre-leasing of Twin Towers. But what we have decided strategically is that lot of capex burn happens in leasing. So we are trying we should have a partner at the initial stage, so that your risk gets diverted, and you can grow your leasing portfolio that way. So that is what we are looking for it. But capital allocation mainly will be in residential this year.
Right. And one question now, where you're targeting to acquire land, is it largely Bangalore? Because you were alluding to one part of the answer in the previous question. Is it largely Bangalore, or you're also actually looking to acquire in Chennai or Hyderabad? No,
we are definitely looking for acquiring land in Chennai and Hyderabad. In fact, in Chennai, we have already tied up a large amount of lands. It's already, I think we'll announce as and when those land deals close. Hyderabad, I think we have already tied up some land, but because of the unlimited FSI, it has been tough to acquire land in Hyderabad. But I think government is coming out with a cap in FSI, and I think then the land prices will be more reasonable. So we continue to look land in Hyderabad, and of course Bangalore is our stronghold, and we are sourcing land here as well.
Okay, and now let me ask you one question to which you were answering a part in your first answer. So now let me do a deep dive here. Cost pressures, everybody knows what is happening. It's a very strange world. We are looking at freight prices, the shipping prices, which have been very high, again, not seen in many years. Steel prices, very high. Cement prices, again, actually have increased. Iron ore prices, like construction material prices have gone through the roof here. So how it is impacting you and how you're really managing it? Is it something where you really actually are seeing there is some pressure on the working capital, or you're seeing that, yes, there could be some pressure on the margins in the near term, and then you will compensate for it with the price increase later? Like how the cash flow situation is going to look like with this unusual environment?
Okay, so I'll give you some numbers before. See, overall construction increase has been, say, three months back was around 13%. After that, export tax was put on steel, and steel prices have come down tremendously. It's come down by 10 to 15%, and which has sobered the market right now in steel. Cement has also come down because of the new expansion which has been announced by Ultratech and other Adani, and also so there is a lot of competition which is seen in cement. So cement prices have come down a little bit. Overall, if you see today, the price increase from 13% has come to around 11% increase overall in the construction area. If you take this on the price increase in the projects, it will tantamount to around 5% of price increase which a developer has to take to sustain 11% of price increase in construction cost. So that price increase each and every developer has taken because everybody has to protect the margin. And in Bangalore, the margins are very, very thin. You cannot work on 40-50% of margin, which in big cities like Delhi or Mumbai people do. So it's a very thin margin, and developers have to protect that. So price increase has been taken by each and every developer, and us also. We have taken overall price increase of around 5 to 6% overall. What we have been doing is that we are looking project by project and seeing to it where the market can accept price increase in that project. So somewhere we have done 3%, somewhere we have done 7%, somewhere we have done 4%. But overall, we are looking at it that our averages is around 5 to 6%, and so that overall margin can be protected for the company.
Well, my last question to you, Mr. Goyal, and this question is especially for our viewers. Let's actually completely tie everything to the earnings growth. Now, we've talked about EBITDA, volume, price, that again leads to revenue growth here. When it comes to earnings growth, how are we looking at over the next 2 quarters? I'm trying to break down the full year into 2 parts here, first half and second half. So how's the earnings growth looking to you? Like pass through from EBITDA to earnings growth? What are your comments?
Yeah, earning growth should be there. I think, see, today earning growth has become a misnomer in real estate because you are recognizing revenue based on AS 115. So, and before you used to do on percentage of completion method. So it's very difficult to predict earning growth quarter on quarter, because in residential, whatever you register is what is recognized as the revenue, not as to what you are selling and what construction you are doing. So it's become a misnomer in real estate terms. Where we have 70% of our revenue coming from real estate. So it is become between difficult, but definitely earning growth will be in the range of 10 to 15% is what I presume, if you are able to do good registration in this year. Commercial will do very well. We will have a revenue growth of around 20 to 22% this year, and earning growth into the range of same, say 20%, because 95% of the earning growth of the revenue is earning in commercial. Hospitality is going to do very, very well, so that will also contribute to a large earning growth this year. So I can think overall, if I can presume, we should have an earning growth of around 10 to 15% this year going forward.
Well, I think that should be giving some real good insights for our viewers. It has been a solid FY22, and as you're highlighting, looks like the underlying momentum continues to remain very strong. Mr. Goyal, as always, thank you for coming on the show and giving those deep insights into the markets, the segments, and also the plans of Brigade Group. Thank you. And thank you, David.
Thank you, Piyush. Thank you, Piyush, for covering our company, and thanks again.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.